Uh, Good evening, everyone. You're welcome to tonight. It's good to have you one more time tonight. I think it's better this way. I need to mute everyone so that nobody will be disturbing us. Once again, good evening tonight. But okay, you can hear me. I can see some people are confirming they can hear me. So it's let me confirm if you can hear me, please. Can you unmute and speak up so that we
Yes,
know
we
that?
hear you,
Yes,
sir.
I can hear you, sir.
All
I can hear
right.
you.
All right. All right. Thank you for that. Guys, it's my turn this night. It's my turn this night, and you're welcome to tonight's class. My name is Joshua Oluwadamilare Olajide, and for tonight, I'll be the one to be walking you through our next, topic. So, although we have our tutors, other tutors that I've been walking you through. But for tonight, I'll be your host, and we'll do this together. The reason why I had to mute everyone is because I don't want distraction. But I think in between, uh, I'll give everybody access to speak so that if you have questions, you come up with, then we I'm not audible enough. So, is it better now? Ma- Oh, sorry. Okay. Can you hear me now? Is it audible enough now?
Yes, sir, we
Yes,
can hear you.
hear you.
All right.
We can hear you. You're
Like
audible and
we are
clear.
not hearing you clearly.
Ah,
I
sorry.
think
You
yeah,
are audible
Maybe
and
You
it's
can
clear.
your
hear me now?
network, sir.
You can hear me now, right? Mr. Peter, can you hear me now? Is it better now? I think he's struggling with his network or something. All right, so no problem. So tonight we'll be moving to a very vital part of this subject, management, financial management, a very vital and very important. If you check the weighing impact on the overall syllabus, and that is speaking specifically to investment appraisal. So let me share my screen. So I have a very simple style. My very simple style is that I'll make the class to be as interactive as I can, so that I'll be sure that you are with me and you also understand the message I'm trying to pass. It is not about just uh, teaching or that. It's about your ability to understand what I'm trying to pass to you. So I'm sharing my screen now. Please confirm you can see.
Yes, sir, we can see it, sir.
All
Yes,
right,
we can see
that's
your screen.
all right. That's very good. So, investment appraiser, a very interesting topic. It is all of us are familiar with. It is something you have been doing either directly or indirectly. You invest and you expect a return. Right? You put your money into a business, you expect a return. You put your money somewhere, you put it with someone, you keep it somewhere, and you expect that over the years or at this stipulated period of time, I'm definitely going to get this reward in excess of what I have invested. So for every business organization, for every individual, it will be very, very unwise step for you to rush into a business without understanding or carry out some kind of calculation, carrying out some kind of tests so that you'll be able to establish if it is a good one for you. Otherwise, you will make a very bad loss. So hence, there is need for us to appraise every investment opportunity that comes our way as individual, as business entity, as corporate organization, as investors. So under this, we'll be looking at a lot of things, but you pardon me for tonight. I won't be staying long. I will spend only 1 hour. I got to not quite long. I'm quite tired, but let's just see what we can do within that time. All right. So let's look at investment appraiser. Just like I have mentioned, there are various investment opportunities that comes our way, and we need to appraise them for us to establish if the investment will actually. Sorry. All right. So it is very important for us to appraise our investment opportunity and establish if this actually what we should go for. So that takes us to a very important concept under investment appraiser, which looks at first, what are the various investment appraiser methods that we have, and how do we use these methods, to arrive at useful decisions for every business organization. In a nutshell, we can look at various investment appraiser techniques from two different angles, from two different lenses. Investment appraisal sometimes is also referred to as, capital budgeting or something like that. So we are still speaking in the same direction. So generally, you can look at investment appraisal from two different angles. There is a technique that we call the compounding effect. There is another technique that we call the discounting effect. It is very simple, right? When I say I discount, when I say I compound, there are two different things, right? Whenever I'm saying that I am discounting, what I'm focusing on is that I want to look at, okay, what will this investment that I want to make in the next, that I want to make now that will yield my return for me in the next couple of years, the next couple of months, what will it worth today? So you have to discount it to the price of today. Don't worry, we'll get there. I will explain the time we'll get there. While compounding, right, is a logical converse of discounting. I'm saying that, oh, I want to look at what this investment that I want to make now, I want to look at what it will worth in the next 10 years. So I want the benefits to compound to add up over the years. So that is just by the way. When I get there, I will break it down. We'll look at it very well. So that takes us to one very important concept of investment appraisal, which we call the relevant costing approach. Relevant costing approach, or the relevant cost. Now, it is very important for us to look at the various relevant cash flow for investment projects. What we are saying is that it is not every input that worth our stress. It is not every information that comes in here that what us are working on. We need to focus on the ones that are useful. We need to focus on the ones that drive decision. So that is why we come about the concept of relevant, cash flow. Now, I will summarize this. I'll summarize this for us. When we talk about relevant costs, basically, we are looking at the cost that, relates to that investment or to that decision that we want to make, that we impact what this decision will bring for us in the future. That is what makes it relevant. So, also, whenever we are defining a relevant costing, we should be very key on some things. Relevant costs, they are those costs that when we assess the economic viability of the investment, there are those costs that we know that we have to take them into consideration. And what makes a cost relevant is that this cost must be a cash flow. Now, you will pay attention to that. A relevant cost for investment appraisal techniques or for the purpose of investment appraisal is that cash flow that will happen as a result of the decision we want to make. So we are saying that relevant costs are those we are saying that relevant costs, they are those cash flow, and they must happen as a result of that decision we want to make. So you are picking some few points there. I think the important point there, I hope you highlight them in yellow so that when you are reading, you'll be able to focus on. So we are saying in a nutshell, relevant cost is the future cash flow that will occur as a direct consequence of making a particular decision. So what we are saying is that the way you the decision you make today, right? The decision you make today will bring some cost to you. And this cost must be a cash flow. Now, let me explain to you what we mean by cash flow. When we say something is a cash flow, from the word, you can even break the words down. One is cash, the other one is flow. When you say cash, obviously you are referring to money, right? When you say flow, when you say something flows, you understand that means it occurs in series, it occurs in identical patterns, and it is repeatedly, right? It is something that happens. It's not one of. It happens. It has a pattern. It happens this year. It happens this month. It happens next month. It happens next year. So that's what makes it a cash flow. So while looking at what's relevant cost is, you might need to lay more emphasis on the fact that your relevant costs are future cash flow. Yes, they are future cash flow. Cash flow that will happen in the future, not the one that is happening now, not the one that's happened before. There are future cash flow that will happen, and two, it must be as a direct consequence or as a result of the decision you are making now. And three, it must be a cash flow. So those three parts are very important. And you understanding this, the best thing you just do is just understand this thing in your own words. You can put them down. You just know that, okay, what is relevant cost? Relevant costs are future cash flow, and they occur as a result of, the decision I'm making now, and they must, happen in the future. They must not be the cause that has happened in the past. So costs like depreciation, costs like interest, or fixed absorb overheads, or any other cost that has happened in the past, which we otherwise refer to as sunk costs, are not relevant when we are defining, or when we are referring to what makes up a relevant cost for a business organization. So having mentioned that, there are some various cost concepts or terminologies. I think if you have any question, just you can go ahead and ask. If you have any question, just go ahead and ask. But make sure you are not disturbing us with your mic. All right. So there are some basic concepts that we just need to have at the back of our mind when we're talking about relevant costs, what is relevant costing, and the likes. This will help us to differentiate between costs that are relevant and between costs that are not relevant. The question can come this way. Let's try forget. The question can come this way. The question can list. I think I came across a question like that during my days. I think was it in PM or SFM? I can't really remember now. Now, so they can list some costs for you, right? They list those costs. They can say transport costs, this, that, blah, blah, blah. They list all of them, right? They will now ask you to categorize them under each umbrella. They can say, okay, relevant costs, irrelevant costs, incremental costs, differential costs, avoidable and unavoidable, committed costs, and sunk costs. So it is your understanding of, or the basic things that defines this element that will help you to put them in the right category that they belong. So let me quickly walk you through these basic terms, which I think is very important for you to understand. So there is a cost that we call incremental costs. There is a cost concept that we refer to as incremental cost. From the word incremental, right? From the word incremental simply refers to additional. That's just another English you use for it. When you say, oh, something is incremental to what I add. So what I'm saying is that that thing is additional to what I add earlier, right? Yesterday, let's say yesterday, I worked 50K, and today someone just out of nowhere decided to bless me with 20K. The 20K is incremental to the 50K that I already have in my account. So incremental cost are just additional cost that comes in as a direct uh, consequence of any business or any investment that we are putting our money and our effort to. And before we can say an incremental cost is relevant, don't forget that one, it must be a future cash flow. Two, it must occur as a result of direct consequence, as a direct consequence or result of the investment decision we are making. And it must not be a sunk cost. It must not be a cost that have happened in the past. So that is incremental cost. It's simply the additional cost that we record over time. That is that on incremental cost. For I think someone's hand is up. Okay, I think the hand is done. All right. Okay. So there's another concept which we call the differential cost. Differential cost. The differential cost is very simple in its own terms. It's we can only ascertain this to be relevant or irrelevant, provided that it meets the term, is a future cash flow, it happens as a direct consequence of the decision we are making, and it is not a cost that has happened in the past. So a differential cost is just that cost or that sum or that amount by which our future costs will be higher or lower if we make that decision based on what we are looking at now. So we are saying that the relevant costs, the differential costs will be that, let's say, okay, going by the example that I've established before. Initially, I was with 50,000, but let's say I invested, I gained 20,000. The 20,000 on it, don't forget, is an increment, right? That's aside. The differential is now saying that now that I have 70,000 compared to when I had 50,000. So there are differences now. 50,000 is different from 70,000. So that makes a difference in between. And unless this cost is a cash flow, that's it. Does it happen in series? Does it occur over time? Does it follow a pattern? It's not something that just happened one-off. You're a business entity, you have invested heavily, so you want to see your money outflow. So it must be a cash flow, and it must be a future cash flow, not something that's happened in the past or what someone is promising is a futuristic cash flow. So that is differential costs. Avoidable and unavoidable costs, as the name goes. When I say something is avoidable, meaning that I can stay away from that. When I say something is unavoidable, meaning that I can't stay away from this. I need to put my money here. It is avoidable for me to say, I won't take 5 bottles of any cane today. I need to save money. But it is unavoidable for me to say, I won't eat today. So meaning that I can avoid taking beer. I can't avoid, I can't stay, I can't starve myself. So look at it that way. Avoidable costs, there are those costs that the company can survive, if they do not happen. Unavoidable ones are no, this one, we must put our money here. We can't do without this. One thing you note that any cost that is unavoidable, any cost that is unavoidable is an irrelevant cost. It's not relevant to us. Wherever you have a cost and we are saying that this cost is not avoidable, it's something we must put our money. It is irrelevant to whatever to any decision you want to make. Because in the first place, you must shall spend that money. You must, let's say, staff salary. You must pay your staff, right? So that money that I've set aside for the payment of staff salary is unavoidable. So it's irrelevant to the decision you want to make. It is something that must be there. Why those costs are avoidable? They are relevant costs. Any cost that is avoidable, they are very relevant. What we are saying is that there will be, if you decide to consider them, they will make an impact. If you decide not to consider them, they will also make an impact. So they are actually moving a thread. They are actually relevant. They are actually influencing whatsoever decision you want to make. So that makes them relevant, and they must be considered when you are looking at any investment appraisal techniques you want to look at. So also there is committed cost. In a nutshell, every committed cost is irrelevant because you already put your money there. You already invested. So what are you saying? It's not going to make any difference. It's not going to. Okay. I don't understand the relevant and irrelevant costs. Okay, so let me take that. One more time. So I explained to you that when you talk about relevant costs, you are talking about those costs that are future cash flow, and they are the costs that will happen as a result of the decision you want to make now. So there are future cash flows, there are future costs that will happen as a direct consequence of the decision, of the action, of that investment that you want to put your money today. Those are relevant costs. They are very relevant to you. So any cost that is the cash flow and it will happen in the future, and it's as a result of that decision you are making now, is a relevant cost for you. Any any other cost that is happening in the other way around, look at it, converse it logically to say any cost that is not a future cash flow, that has happened in the past, that is not as a result of the decision I'm making today, is an irrelevant cost. I hope that answers your question. The person that dropped the message in the chat box. All right. So I can see some answer. Faith. Faith, you can go ahead.
Okay, good evening, sir, and thank you for making out time for today's class. This the avoidable and unavoidable. Please, can you throw more light on it? Like I didn't get that part.
All right. All right. I will take that again. So from the word avoidable, from the word unavoidable. So now I cited an example. I can decide to say today I will not take beer. I can avoid it. It is not a do or die something. If I don't take beer, I will not die. So that the costs of buying that beer is avoidable cost for me, right? While unavoidable cost is to say I must eat today. I have to buy bread. So it is unavoidable. Good. So the same scenario is also applicable to every business organization. There are some costs that the business must, commit something to every month. For example, let's say you are working, they must pay you every month. The cost of paying you is an unavoidable cost for your business. And what we are saying is that if any cost is unavoidable, then that cost is not a relevant cost to the decision that will happen as a result of the investment. Don't forget we are dealing with investment appraisal. As a result of the investment opportunity you are seeing and you want to put your money in. While the other one, which is the avoidable cost, is a relevant cost. Why? Why is it relevant? It's relevant in the sense that if you avoid it, you save something. If you don't avoid it, you spend something. So overall, it will impact whatever you choose to do, will impact your financials. If I buy 5 bottles of anything today, I definitely have to pay them. I have to part away with some funds. But and the impact of that is that my money will reduce, right? But if I refuse to buy anything, my money will not reduce. So the decision there lies with me. And whatever decision I'm making today, the impact will speak on my financial. So that is just a simple way to look at avoidable and unavoidable costs. I hope that answers your question.
Okay, yes, sir, thank you.
All right. There's another person, Joshua. Joshua, your hand is up. You can go ahead.
Thank you, sir. I've already answered my question. That is the point which I wanted to ask before. Unavoidable
Okay.
and avoidable.
Okay. Then
Yes.
if Oluwa, this Oluwa,
Good evening,
I'll go
sir.
ahead.
Please, I want to ask about this course, relevant and irrelevant. So you're saying that any course that is avoidable is relevant. Like, is it in just the costing or in real life alone? Because I'm just checking unavoidable costs are supposed to be what is relevant, but avoidable costs are now relevant. Like, I don't understand that aspect, sir.
Okay, let me take it one more time. Please go on mute, Joshua. Let me mute you from here. All right. So, okay. All right. Let me take it one more time. So, we are speaking to investment appraiser. I should explain the big picture so that you can see. Now, if you're lower, you have money in your account, right? Let's assume you have 10,000 in your account. You work in Lagos, you must go to office every day. It's a must unless you are doing remote or hybrid. But let's say the system does not permit that. You have to go to work every day. You have to commit something to that. You spend money on transport. Let's say every month you spend 2,000 naira on transport, right? That 2,000 naira that you want to spend, right, is unavoidable cost for you. Very, very unavoidable. You can't avoid it. You must put that unless you want to trek to your workplace, which I know you can't. So it is an unavoidable cost for you. Note that first. Then
Yes, sir.
secondly, right? You can say you need to eat. Right. Okay, let me just put it that way. Oh no, don't let me use that. Then secondly, you want to say, okay, I need to go to the cinema once in a month. And to get a ticket costs you 3,000 naira. That 3,000 naira that will cost you to get a ticket, unless there is a condition attached to it that you must watch a movie, you can decide to say, I am not going to watch a movie. Then the point there is that 3,000 naira you would have spent on buying the movie ticket, you can avoid it. It is what? It is avoidable, right? It is avoidable. Look at this from the lens of you are investing. Now, that cost that is avoidable, saying that, oh, you can decide to buy the ticket or you can say you are not buying, is a relevant cost for you. And I will explain to you why it is relevant cost for you. The initial cost of transporting yourself to the office and coming back every day is not relevant. It's not a relevant cost for decision making. No, we are speaking to decision making. No, now it's not a relevant cost because either you like it or not, is a must, right? You must spend something on transport. So either you consider it in whatever decision you want to make or not, is not moving any trend. So it is not an unavoidable cost for you. But there is a cost that is avoidable. The cost that is avoidable is that cost of you buying a ticket. Why is it avoidable? Good. And why is it relevant? Good. I will explain one more time. It is relevant because if you buy that ticket, you'll be left with 5,000 naira. That is a position. If you decide not to buy it, you'll be left with 7,000 naira, with 8,000 naira rather. So the fact that that cost can influence your financial position, make it relevant to you. You can avoid it, noted. If you avoid it, you save money. If you decide not to avoid it, then you won't save your money. So avoidable costs can put you in a position and it can put you at the other side of it. That is what makes it relevant. It influences your decision. Does that answer you, Ifeoluwa?
Yes, sir. Thank you, sir. Yes, sir.
All right. There's no answer again. Okay. So I've explained committed costs. Then there is a cost concept that you also need to explain, which is the sunk cost. See, anywhere you have sunk cost, don't just bother yourself much. The word sunk cost means that those costs that already happened in the past, historical costs, and costs in multi-shell, sorry, don't mind me. Those costs already happened in the past. So you can't say they will drive what will happen to your investment. Mind you, in cash flow projection, to be specific, in cash flow projection and financial analysis, I'm a finance analyst, we look at the trend over the years, we look at what has happened in the past, blah, 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 or something. But we are saying that, see, when we want to put our money out there, we want to be very sure, beyond reasonable doubt, that whatsoever information we are using is as accurate as it is. Decision must be an information within very reasonable time. So you can't tell me that you want to run a 5 years projection of what your financials will look like in the next 5 years, and you're now giving me the data from 1992. It will not help what is currently happening. So that cost that has happened in 1992 is a sunk cost. And sunk costs are costs that has happened in the past. And we are looking at them that, see, they will not really help us in making a decision regarding what to invest on. So some costs are basically irrelevant costs. Yes, I'm talking. They are very irrelevant. They won't help you make any reasonable decision, even if you bring them in. Because that's happened a very long time ago. You $1 to $1 was, let's say, 150 naira. 150 naira to $1. And now that dollar is 1,500 naira to $1, that information that year will not really help you. So you need to look for something that is very close within very reasonable time. So that is some cost, basically. You understand it. So the other one is opportunity cost. Everyone understands this. This is, the alternate foregone when you are making the choice. So I think I don't need to stress myself much on opportunity cost. I want to assume that we understand it. But one thing you must note when it comes to opportunity cost is in the real sense of it, in the grand scheme of things, it is not actually a cost in the sense of it, but we use it for comparison's sake. We use it for comparison's sake to say, if I let this go, opportunity cost now. If I let this go, or if I do not let it go, what will be my position? What will be the alternatives? That I will have to forgo. What will I lose? So basically, that is opportunity cost, and these are the various costs, relevant cost concept. You can master all these things. Just read them one more time, and just try to think about it. Don't cram. Don't cram. Just read to understand. I don't cram. I just break words down to my best, and try to assimilate, think about it, and you are good. All right. So before we move to the various to the various investment appraisal tool. So at this point, is there any question? Let me check one more time. Okay. There is no question. Oh, I've muted everyone. Did I? Okay, no. All right. Oh, good. Is there any question?
No, my hand is raised.
All right, go ahead. Go ahead.
Okay, sir, if you don't mind, in this context of investment, can you explain like opportunity cost?
Okay.
Very
Okay, I'll do
well.
that. Sure, I will do that. All right. Opportunity cost in investment appraiser is just that benefit that will be lost, that benefit that you will not get if you refuse to invest or if you decide to invest. So it is just a kind of comparison to say, if I put my money here, right, what will be the effect? If I refuse to put it, what will be the effect? So it is just that alternative. Okay, which example? Okay, let me use the example that I used for Ifeoluwa the other time. So if Ifeoluwa decide not to buy tickets and decide not to go to work, she has 10,000, right? Compared to when if follower goes to work, if follower did not go to work and refuse to buy a ticket, refuse to spend that money, she has 10K. Yeah, that one is there. If follower goes to work, definitely 30,000 naira will go. 2,000 naira will go for transport. If he buys ticket, 2,000 will follow, 5,000 will go in total. So you compare what impact that 5,000 will have in your initial position, and you compare what the impact that 5,000 will have compared to your initial position. So basically that's just opportunity, because is that alternate, is that alternate that you will forgo, or you decide not to forgo whenever you are making a choice. So it is just for comparison sake. So that's it. Does that answer you?
Yes, you did. Thank you.
All right. Faith, your hand is up. Go ahead.
Yes, you've explained what I wanted to ask. But another thing is, that means opportunity cost is a relevant cost, right?
Okay, so opportunity costs is not a relevant cost, right? It is not a relevant cost. It is just a cost for comparison sake. It is not, in fact, we don't even look at it actually as a cost, because you are not recording anything basically as an opportunity cost for you in your book. You just use it for comparison sake. So your conversation on opportunity costs stop at, say, okay, let me compare if I do this. So because most times there's no conversation that you have that will take you down to opportunity cost and say, is there benefit? The point there is that you want to put your money out, you want to appraise your investment. Of course, you understand your position before you put your money. You also fully understand what your position will look like if you decide not to put in your money. So that is just basically what opportunity cost is doing there. Nobody is actually looking at it.
Okay, sir. Thank you.
All right. So let's go to the business of the day, to the real investment appraiser you done, the various investment appraisal techniques. So I mentioned to you that time that we can look at it from two lenses. One is discounting, the other one is compounding, right? And this investment appraisal technique, there are many. We have payback period, we have internal rate of return, we have accounting rate of return, we have profitability index. But for the sake of the chapter we will be focusing on the payback period, the accounting rate of return, the net present value, and the internal rate of return. Then from next class, we'll continue from there, and let's continue from there so that I'll be able to leave when it's 10. Okay, so let's pick it one by one. Payback period. Payback period. Pay me my money. All right. So when I say payback period, now there is a way I learn, and I don't know if it will work for you, but let me just try to tell you. There's a way I learn. Let's say I can't see all these ones that I have here. I can't see the explanation. I've not seen the explanation before. I'm just assuming that I've not seen all this explanation. And someone just writes something on my sheet, payback period. Without thinking much, before I read, I first want to test my understanding of payback period. What does it mean? In my own words, can I even think about it? So I first go ahead and think. Like, if someone is just asking me to explain what payback period is, will I be able to explain? And how best do I know this thing? So how do I do this? I break the words down. Now, I have the word payback. I have the other word, period. Now, what does this mean? Let me pick them one by one. In payback, what am I seeing? I'm seeing two kind of words there. One is pay, the other one is back. What does payback mean? What does payback mean? Pay means that return or give me or give someone, or you go have give person money, right? Back means that, like, if you are taking something back, meaning that you have given that thing out before, so you are taking it back. So it's coming back to you. So I can now say, okay, payback period is saying that if I look at it, definitely maybe I've given somebody money or I've sent money out, but this time I am taking it back. So it's coming back to me, payback. Okay. I have been able to understand that. Then period. Anything period has to do with time. When they say period, period one, period, whatever, we are talking about time. So if I say payback period, what am I talking about? I'm looking at the period, I'm looking at the year, I'm looking at the month, I'm looking at the week, I'm looking at the days. It will take an investment to return my initial investment with that one that will come after, which are the, the gain or the benefit. In a nutshell, payback period look at the length of time that you have to get back or regain that your cash that you have invested in the business or in the project. So what we are seeing in the recent of it is that, let's say a fellow has 10,000 naira. So a fellow decide to buy a stock in my company, Joshua Nigeria Limited. Now, when the follower came, the follower gave me 10,000 naira. And I said, okay, follower, this 10,000 naira, I will invest it now, but I will not be able to give you this money or any interest that will come with it now. But I'm telling you that I will keep giving you, I'll keep giving you 20, no, I'll keep giving you 2,500 naira. No, that's too low. I'll keep giving you 4,000 naira on yearly basis. You have invested 10,000 naira with me, right? So I'm not promising you that I will give you, I'll be on yearly basis, I'll be giving you for 4,000 naira. So what I'm then, if you want to calculate the payback period, so you want to look at it like, okay, how long will it take if you do to get back our money, that initial investment first, before any other before the interest or the gains that comes after it. So what we are saying is that if I give fellow 30,000 naira the first year, I'm still owing her 70,000 naira. If I give her another 30,000 in second year, I've paid 60,000 out of our initial investment, so I have 40,000 naira. If I give her another 30,000 in the next in year 3, I've given her 90,000 naira. Then by year 4, if I give a follower another 30,000, meaning that I've given the follower 12,000 rather. I've given her 12,000. Now, what we are saying is that the payback period for a follower investment is 3 years and some months, because yes, she will definitely make make her initial investment sometime within that 3rd year, and few months after. So that is just payback period. It looks at the period of time that it will take you to gain back whatsoever you have invested. So let's look at this simple example that I added to the note here. So I'm saying that suppose that a project will involve capital expenditure of 80,000 naira, and annual net cash return from the project will be 30,000. You see, you invested 80,000, right? But on yearly basis, what will happen? What will happen? You will keep getting 30,000 naira per year. How long will it take you to get your money back? It's very simple. It's very simple now. Just pick that your 80,000, which is your initial investment, then divide it. The reason why you can divide it straightforward this way is because the question says that 30,000 naira is a constant value you'll be getting each year. It will not change. I give you 30,000 this year, I give you 30,000 next year, I give you that. So do I want to? So if I keep giving you 30,000 every year. How long will it take me to give you your initial investment? So it's very simple. Pick the 80,000, which is the initial investment, then divide it straight away by, a yearly repayment. So that will give you about 2 years and 7 months. So that one is pretty straightforward because the cash flow, the yearly cash flow, is a constant amount for the years. It will not change anytime. And there is a decision rule for every investment appraisal technique. For payback period, it's very simple. What we are saying is that you will only select projects. Now, let me tell you, when they give you question on investment appraisal, what they are telling you is that as a finance expert that you are, help us analyze this, then advise us. That advice is very important. Then after you have appraised this, how do you advise? Then you need to understand the decision rule. The decision rule for payback period is that you only select projects that will return or that will pay you back within a specified time. Maybe in the question they tell you that only accept project if it will return or if it will pay you back in 2 years' time. So after you are done with your calculation, you need to check your question and say, okay, what's the payback period that they are specifying here, right? Or if they do not put any specified date and you have so many projects, then the project you need to accept first will be the project with the shortest payback period, of course. So that is it. So quickly, let's look at the question. Let's look at the question together. This is a very simple question, a very short question. So one thing is that what you need to understand is that you just, okay, should I say about icons? You just have to understand the concept. That will help you once you understand the concept, because most time they might try to just test your level of understanding of the concept itself. So that is why you just need to once you understand the concept, once you understand the basics, then you don't need to struggle with anything. Good. So you have a question here. The question is saying, let me zoom out so that. All right. So this question is saying, there is a project that will give us a series of cash flow for 5 years. This question is different from the question I just showed you here because of one reason. What is the reason? The reason there is that for this question I showed you earlier, the repayment of 30,000 will not change over the year. So if they repay 30,000 this year, next year they repay another 30,000. The year after they repay another 30,000. They keep repaying 30,000 over the year, so it's not changing. Unlike this scenario, where in year one they will pay 300, year 2 they will pay 500, year 3 they will pay 600, year 4 800, and year 5 800. So the repayment, which is the cash flow, is uneven. It's not a static amount over the years. So let's get right into it. Now you have the years from year 0 to 5. The year 0 is the year of investment. The year 0 is the year of investment, right? Hence, your investable capital, your invested amount, is what is the only thing you have in year 0. That is why for year 0, you have the original investable amount of 1,900. That is the only thing you have in year 0. Then in year 1, you have 300. So what they are saying is that in year 1, you have started receiving cash. So how do you ascertain the payback period? Add a column. That is the column you want to use to do your working. And that is the column that you call payback period. They have given you a column for year. They have given you another column for cash flow. Then you need to add a column for the payback period where you'll be able to ascertain the period itself. Then under payback period for year 0, what do you have there? You will still have the amount that you have invested because you have not received anything. So that is the only thing that you have for that. Okay, so in year 0, your initial investment is what you are still regarding as what is as your only cash flow. Nothing has been given to you. So bring it to your payback your column. Bring it here. Then you want to start the work. Listen so that you understand it. You want to do something very simple. And what is that? What you will now do is that now in year 0, now in year 1 rather, I have received 300. I have received 300. Then what do I do? The next thing I will do is to say the 300, I want to take it out for my initial investment. I will now say 1,900 minus, this is minus 1,300 minus the 300 I've received in year 1. The reason I'm putting plus in my formula is because of my initial investment is in negative. It's just Excel addition. I hope you understand it. All right. So if I say 1,000, just a minute, please. All right, I'm back. Okay. So I'm saying that 1,900, which is my initial investment, minus 300 that I have received in year 1. So what will be my balance? My balance will now be 1,600. You understand it to this point. Let's go ahead. Then for year 2, I'll do the same to say 1,600 minus the 500 I received in year 2. It's very simple. So I do this, I say this minus this, then I get 1,100. Still a negative number. Always pay attention to that. Still what? A negative number. Good. That means that the project at known will pay me my invested capital as at the end of year 2. So I'll go ahead to year 3 to say, okay, what was happening in year 3? In year 3, I received 600. This is 600. I received 600. So what do I do? So I now see 1,100 I closed year 2 with minus 600 that I recorded in year 3. Then I have 500. So what I'm saying is that as at the end of year 3, I still have a negative cash flow. The project has not paid me my invested capital. So I move on to year 4. What happened in year 4? In year 4, I received 800. What do I do? I'll now say, okay, 800 that I received here minus what I closed year 3 with. Then what happened? Something happened in year 4. My cash flow turned to positive, right? So what I'm saying is that this project in year 4 has paid me my invested capital. This project has paid me my invested capital in what? In year 4. So my payback period ideally should be year 4. But I want to be detailed. I want to be detailed enough. How will I how will I be detailed enough? So I want to say okay, yes. So I want to be detailed enough. So I want to say, okay, which exact period did this happen? This is month, this month, yeah. And to say which exact period does this happen. Now, how do I do that? Pick, let me change it so that when you have this Excel, you'll be able to do this divided by 20 page, multiply by 12 because you have 12 months in a year. You have 12 months in a year. So ideally, I'm saying that these projects will pay this person at the end of 4 years with by duration of 4 years and 7.5 months. 4 years and 7.5 months. So basically, that is what we are seeing. Because what happened? What happened is that what happened here? What happened is that your cash flow return to positive at year 4, right? Year what? Year 4. Then check it further to say which month exactly. And for you to do that, for you to establish that, just pick the last negative item, divide by the next positive item, which is this, and this, and this, and this. 500 divided by 800, then multiply by 12. Of course, 12, we have 12 months in a year. So you'll be able to use that to establish the months that it actually happens. So we are saying that if you take this business 4 years and 7.5 months, let's say 7 months and 15 days, 7.5 months, yeah, 7 months, 4 years, 7 months and 15 days to recover this 1,900 if they invest it and if the cash flow follows this pattern. So that is just a simple lookout of how to ascertain or calculate payback period. Payback period question can come in two form. It can come this way, where they give you a table. They give you this table, and also it can come this route where you don't have a table. They will just tell you in the question that it is a constant amount for each year. This is the simplest thing. Pick that cost, the project cost, divide it directly, don't stress yourself, by the annual payment amount, then you'll be able to establish the year and also the month. So it will be good to reiterate at this point that as we go deep, this is just like an introductory aspect. As we go deep, the course also make room for some other kind of, I don't want to say complex, for advanced payback periods and the likes. Don't worry, I'll also be the one to walk you through those ones, just to get you familiar with what payback period is at this point. Is there any question on payback period? I want to be sure that you understand. Any question? Mr. Peter. I was not able to hear me the other time. Mr. Peter Peteru.
Evening, sir.
All right, good evening. Good evening, go ahead.
Sorry, your voice is low. It wasn't like this before, so I can't hear you properly.
Sorry.
Thank you.
Is it the same thing for everyone? Or she's the only one?
Good
I
evening,
can
sir.
hear you
Good
clearly.
evening, sir.
I
I
can
heard you
hear you
clearly,
clearly.
sir.
Oh, okay.
I
So
can
that
hear you.
person, that person
Hear you,
might need
sir.
to check network or something. All right, go ahead. Someone is Bemisola.
Good evening, sir.
Yeah, good evening, sir. So I got the minusing part when we were minusing payback and then cash flow. But the part where you divided, I didn't really get it. I didn't understand that.
Which other? Okay, okay. Let me answer that. Let me take that first. Now, what I'm saying is that look at this. Look at my column 21. Column 21 is where my payback return the positive number. Year what? Year 4. You will see it's year 4, right? But I can see from the question that it is year 4. Good. That one is simple. I also need to know which month in year 4, because it's not this thing happens. This thing happens in year 4. Noted. In that year 4, the date that makes up year 4 for that company? Obviously, no. Or yes, we can't say that. We need to go further to ascertain that. To ascertain it, it's very simple. Look at, let me help you color it, that you'll be able to note it. Good. So to ascertain it, it's very simple. What do you want to do? Pick the last negative cash flow you have. That last one, that last negative cash flow that you have under the column for your payback period. And obviously, that is the last time your project refused to give you a positive return, right? Then divide it by the next positive cash flow that kind of swallows or consumes the negative number. Divide it. Once you divide it, what you are doing there is you want to ascertain what portion of, let me just take out this 12 first so that you see something good. So if you see, what I'm saying is that 500 makes about 63% of 800. So what I'm saying is, if you do 500 by 800, so it's just about 63%. Then the rest of them, which is about 37%, is positive number, right? But now we want to convert this to months. I'll just say to convert this to month, I'll just multiply by 12. Number of months in a year, because 1 year you have 12 months. So if I divide that, I'm now telling you that, oh, as at the end of 4 year, after 4 year and 7.5 months, which is about that 6.3 period, 6.3% I just show you, that was 6.3%, right? Yes. So that was when you were able to ascertain and get back your invested capital. So you take this business 4 years and 7.5 months to get back what they have invested. Does that answer you?
Yes, it does. So that means under our cash flow, the amount in brackets is the amount that we wasted, right?
Sorry, I'm not getting that. Can you take
Okay,
that
so
again?
I said yes, I do. So are we saying that under our cash flow, the amount we invested is the one in bracket, the 1.9 million?
So this 1.9 million that you have here is your initial investment, and it
Okay.
is that same amount that you have brought to the column. If you see my, who is this person? Ah, aha. So what we are saying is that your cash flow in year 1, which is this 1.9 million, in year 0 rather. Year 0, you have not received anything. You just put your money up there. So it remains as it is. It remains as it is. It is in year 1 that you started taking something, right? That you started receiving money. Now, what you have invested in year 0 remains as it is. This is it here. In year 1, you now receive 300. What do you want to do? You need to offset what you receive from what you have invested. Of course, you are running a business. You already invested 1 million naira. Somebody now gave you 300,000. The next thing you will do is to say, okay, take this 300,000 out of 1 million. okay, I still have 700 I'm expecting. That is basically what we are doing here. We're now saying, okay, 300 naira out of, who is this person now? Ah, I muted you. Unmute yourself again. Mr. Is it Mr. or Mrs. Abiodun? Are disturbing also. Okay. So basically, that is what we are doing there. So we're saying 1,900 minus 300, then we arrive at 1,600. Repeat the same step in year 2 to say 1,600 minus 500, you arrive at 1,001. Then same thing, do it in year 3, you arrive at 500, still negative. Then in year 4, if you do the same thing, your cash flow have returned a positive number here. This one. Your cash flow here has returned a positive number. The first message that is passing to you is that you have recovered your initial 1.9 million. You 1,900. You recover it in year 4. Good. That one is pretty straightforward. Which exact time in year 4, right? And we are now saying that to ascertain that, pick the last negative value you have under your payback and the positive value that turns that into the next positive under the positive cash flow that turns your payback into a positive number. Then multiply by number of months in a year so that you'll be able to ascertain which month. So we're saying that it takes this person 4 years and 7.5 months to make 1.1 million 900 1,900 whatsoever he already invested.
Excuse me, sir. That this 7.5, can we convert it to 8 months?
Well, either you convert or not is not. I don't think that one should. I don't think you should be penalized for that. But regardless, in situation like this, I always like to put my solution in 2 decimal places. Just feel 7.5. It's not. But I don't. If you are not putting it in 2 decimal places, I don't think you should be penalized. All right.
Thank you, sir. That's it.
Okay. Let's move on. It's past. Okay. So you have various advantages and disadvantages of payback period, which I think is something we have to look at now. The one very basic advantage is that it is the simplest of every investment appraisal technique. It's the simplest of every investment appraisal technique. That's the least, in fact, that's one investment appraisal technique that you can, even when you are sleeping. Sorry, a minute, please. Hello, what might be? Sorry, I'll be done. I'll be done very soon. No verse. Oh no. No verse, no verse. Match it on alcohol. Right, I'm back. So one very basic advantage of payback period is very simple. You can see how simple it is. It is very simple to calculate. Even when they wake you, you can wake up anytime so far you understand they calculate it. And it is also very useful in some certain, when there is certain or wherever, some certain situation where there are a lot of uncertainties, when the economy is changing rapidly, when you need to improve your investment decision and the like. So it is very useful in those periods. And another benefit is that it pays attention to quick returns. So it favors projects that returns or give you back your money as quick as possible. So it doesn't really focus. So it doesn't really focus on the amount you are giving us subsequently or something. So the major focus of payback period is that time, fast. How fast will I be able to get back my money? So getting your money, Mr. Joshua, come on mute. All right. So getting your money back very fast will help your business grow. You can also reinvest in some other profitable outlook, minimize your risk, and of course, you are liquid enough because you have enough cash. You have money, right? And also, it helps you maintain an healthy cash flow as opposed to accounting profit. Now, let me explain something to you now. Uh, let me explain something. There's a difference between liquidity and profitability. A very good, a very valid difference between liquidity and profitability. In FP&A, there's something we used to say. We used to say that profit is good, but in the long run, cash is king. Profit is good, but in the long run, cash is king. So what we are saying is that it is possible for your business to be making profits, but at the same time not healthy. In fact, your company can be suffering. Your company can be suffocating. It's about to, to pass out, but still be recording profit. You see the happy and you see profit, then you'll be happy. Oh, we are making money. Good, you are making money. But are you liquid enough? Are you liquid enough? So there is a quantum there that must maximize or that maximizes your liquidity. That is what IS 7 statement of cash flow is addressing to say, okay, let's have a standard that guides how a business will survive. Because it's not enough to be reporting profit. It is very important to say, are you liquid enough? Do you have sufficient cash? Or do you have sufficient cash equivalent, something you can easily convert to cash to cover for your day-to-day activity? If not, that business is in trouble. No matter what you are recording in your financial, if you don't have sufficient cash that will help you survive, that business can crash. Because when your suppliers come, they need to supply you raw material. You don't have money to pay them. When some other people come, you need to buy some basic things that will help the business grow. You need to buy four. You don't have the money. The business will not function. So in the long run, cash is king. So it is what it is. So this method helps you look at cash flow, how cash is coming in, and not just the mere accounting profit that you have in your P&L. This does not, go without its own disadvantage. Our own disadvantage is that it ignores the time value of money. It ignores the time value of money. Now, what do I mean by okay? Don't let me go deep into that. Okay, so it ignores the time value of money. I will explain to you better when you get there. Then also any profit that comes after the paper period, then this guy will not look at it. It will just ignore it. So it's another disadvantage. It doesn't consider the timing of the cash flow. It just look at see, have you returned my money? And it's okay. And it's sometimes they don't look at profitability. What you just look at is that have I made back my investment amount? And with that, it's okay. So just go over this and you see that it's something that is very simple. So that is that for payback period. Let's look at accounting rate of return. This is one of my favorites. ARR, accounting rate of return. Now, what am I saying when I say accounting rate of return? I'm saying that I can also use a technique to decide if I'll put my money in a business or not. And what do I look out for? I want to look out for the expected annual accounting return. Let me help you vote this. Expected annual accounting return.
We can't see your screen.
Yes, sir. Okay.
Is it only you
Log
or
We
in
can
everyone?
and
see it,
log
or we can
log out
see it.
and log
We
in,
can
bro.
see
Log
it.
out and
If
log
you
in.
are
Can
on the
see
phone.
it.
You can see the screen.
See, everyone, please. I don't have any issue with my network. If you notice you can't see anything or you can't hear me, the first thing you do is to check your network. To check it at your end. Just ascertain that before you stop us. Thank you. All right. So accounting rate of return, right? What we'll do here is to ascertain what is that rate, what is that amount that must serve as a return for us every year that covers, that runs through the year, the life cycle of the project, right? So in a nutshell, ARR, as the name goes, is that profit. Now, this time it's being specific about profit. The major difference between this and payback period is that payback period just want to look at what was that period I'm getting back my money. But this one is say, Oga, I'm not specific about period alone. I want profits. I can't put my money in your business and you tell me that it is enough for me to get back my money in the next 3 to 4 to 5 years. I need profit on this. I'll now say, okay, wait, let me use accounting rate of return to estimate if this project will be something reasonable for me. So most time what company used to do is to say they will already establish a percentage. They can say 30% is our rate. If this project is not giving us 30% yearly, we are not taking it. So then as the finance analyst, you take all the inputs, you do your plus and minus, you do your calculation, you speak magic into number, you come out with your insight to say, see, this project is showing us that we're going to get 25%. It's not meeting up with that 30%. Then what was the decision? We reject it because you can't, obviously, if it is your money, will you go and invest it in something that is very low compared to what you can accept? So that is it. That is accounting rate of return. There are various advantages and disadvantages of accounting rate of return. But before we go there, let me quickly show you this example of accounting rate of return. I want to bold it. All right. So the accounting rate of return, there's a question here that is very specific. So this question says, a company is considering a project which require a minute, please. I think there are some questions on YouTube. I can't hear you. Yeah. Oh, okay. I think that the person is fine. Okay. All right. So there is a question that says a company is considering a project which requires an investment of 120,000 naira in machinery. The machinery will last for 4 years, after which it has a scrap value of 20,000 naira. The investment in addition, the investment in additional working capital will cost 15,000 naira. Then they gave us the precision. They gave us the precision over the years. 45,000, 45,000, 40, 25. What they are saying is that 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 uh that machinery will depreciate over a year. They have calculated the depreciation for us, so we have it. So they're saying that for the full year, for the 4 years, it will do 155,000 is total depreciation. So the question goes further to say the company requires a minimum accounting rate of return of 15%. You can see now, minimum, that's the decision. Say 50%. If it's not making 15% from this project, we should not accept it. The least the company can do is 15%. So should the project be undertaken? That's the question for you. So let's get right into this. Now, before we get here, right? one thing I need to mention or call out for you is that, I was explaining when I was explaining relevant costing the other time, blah blah blah, costs, some costs, good. I mentioned something. I said a cost that's happened in the past is what is a sunk cost, and we don't consider it uh, in our investment appraisal. So you need to be having all those definitions at the back of your mind when you are reading the question line by line. Have those definitions at the back of your mind so that you know what you consider and know what you will not consider. What is the first thing you want to do? The first thing you want to do is to establish something. You want to establish what your profit looks like before depreciation. Depreciation has been taken out of the profit that is being reported here, but you want to calculate and establish that first. What is my profit before depreciation? You have been given depreciation in the question. You have it year 1, year 2, year 3, year 4, right? Then first thing, ascertain the total depreciation, 155,000. What am I saying? Oh, no. You want to establish the profit before depreciation. How do you go about it? You already have the cash flow, which is the 155,000 per year. That is the expected annual profit. That is what you have over here. Then what is the next thing you want to do? The next thing is to ascertain your depreciation. Then get the net position first. Get a net position after you have considered your depreciation. Then we'll go back to the question. What was the question saying about depreciation? The question is saying that initially the investment amount is 120,000 and it will last for 4 years. Then there will be a scrap value of 20,000, right? Then what's the next thing we do to ascertain our depreciation? It's very simple. If the initial investment costs 120,000 and at the end of the year, the depreciation, the scrap at the end of the useful life, rather, the scrap value of this project is 20,000. Definitely something has happened over the years. That thing that has happened is the depreciation. That is the difference between the original amount of that investment and the scrap value at the end of the year is the depreciation. So it's very straightforward. Just take out the 20,000 from their initial investment of 120,000. Then you are certain your 100,000 naira, which is your depreciation. That is the first thing. You have been able to ascertain that. Then what is the next thing you do? The next thing you do is to ascertain what your profit will look like if you have considered depreciation, because that is one profit you want to get. They are giving you all what the profit will look like for the years. But don't forget that the fact that this machine is making money for you also justify the fact the machine will be losing value. The value will be reducing, right? The rate at which it reduces it's your depreciation, is just the systematic allocation of the cost over the useful life of the asset, right? So that is what we have done here to say, okay, 120,000, the initial cost, minus 20,000, which is your scrap. Then you will be able to ascertain your 100,000, which is your depreciation. Then for you to ascertain what your profit is, what is that your exact profit? Take out the depreciation from the profit. You arrive at 55,000 profit. This 55,000 profit is for the whole year. It's for the useful life of the asset, which is the 4 years. Then what is the next thing you do? Of course, you want to establish the actual average accounting profit. Okay, the formula. Oh, I've not given you that. The formula for ARR, let me type it. ARR formula is average average investment investment divided by average annual profit. Of course, you multiply by 100% because it's always in percentage. So this is the formula for you. All right. So after you have been able to ascertain what the profit is after depreciation, then what is the next thing you want to know? Okay, per year, for 1 year, what will the profit look like? Take the profit you have calculated and divide by the number of years, which is given to us in the question. The question mentioned to us that the project year is 4 years. So what we are saying is that a year after you have taken out depreciation from your profit, your annual average profit per year is 13,750. Calculated that. That is one thing. Then there is something that this one is very important. There is something you need to now do, right? You need to calculate what we call annual investment, average investment rather. Average what? Investment. Now, how do you calculate what your average investment is? It is very simple. There is a concept of capital employed. Let me see if you are still hearing me. Hey, someone's on this up. Go ahead and ask your question, Mrs. Sherman.
Good evening.
Good
So I want
evening.
regarding the depreciation, I was thinking depreciation is cost minus scrap value divided by the number of years, which is 4, but it was not divided by 4.
Okay, so either ways, right? If you do it that way, or you do it this way, you are still going to get the same thing. You can try it, right? So you will see that below here, I have divided everything by 4. This is why I did my divided by 4. So if I say this, what I've calculated here now, if I say this divided by 4, I've been able to ascertain what my depreciation is per year, which is 25,000, right? So if I now say for each of the year, I want to say, okay, let's say I pick year 1 and I say this plus this. I have 20,000. But there is something, right? There is something in this scenario that won't take us that route. So if you do it, we are still getting the same thing. Why? Well, what is that thing? That thing here is we are looking at this from the concept of, say, we want to look at the average return. Average return. Because when we're having the conversation will be around what will this give us on an average. Is an average number. So this 13,750, we have averaged it. The depreciation value, we have averaged it. What we did for the depreciation is that we do not consider the various peculiarities of the profit in this year. You can see year 1 is 45, year 2 is 45, year 3 is 40, year, and the last year is 25. So they have different values, not the same values, right? And what we want to do is to just say what is the average. So we are using average this time. But if, thank you very much for calling that out. If the question goes further, right, to if your question goes further, by requesting you to establish for year 1, year by year, I beg you in the name of God, don't average it, please. Don't worry. I think I have a question that is very thick that I will still bring. So that is that. This is an average value. I pick all the year, I pick up the profit for all the year. we sum everything together. Okay, pick the depreciation for all the years too. We sum everything together. We less the depreciation from the total profit for all the years. Then we say, okay, let's get an average profit, average annual profit. How do you get average? Pick what you have for the 4 years, then divide by 4. Then you are starting 30,750. So that is just it. So both approach are correct, but going by but most time, honestly, I won't honestly to be fair with you, but most time these are the approaches you'll be seeing to questions. Because one say annual average investments divided by annual average annual average accounting profit whatsoever. So it's still a concept of say average to say, okay, on a yearly basis, or if worst come to worst, I want to see 15% per year. So I'll look at it on a straight line to say, okay, get me an average value. Then each year, if I'm not seeing that value, then I'm not taking the project. So that's it. Hope that answers you.
Thank you, sir.
Thank you, sir. Please,
So,
can I ask a question? Can I ask a
Go ahead.
question?
Go ahead.
How
Guys,
did
I
you
was
get
I was
our
check out
average investment? Because I can see how we got our accounting rate of return. Is average investment divided by the annual profit, which is which
that is
we
what
got.
that is what I wanted to explain before I want to ask a question. So I've not explained it. That is what
Oh,
I want to explain. So
okay.
guys, I would dash out by 10:45, please. On Tuesday we'll continue from me. Okay. So uh uh okay, so let's look at average investment. So it is important for us to understand this. There's a concept we call capital employ. Capital employ, right? This capital employ, the concept of capital employ is saying that, how will I put this? Okay. He's saying that as an individual, as a business, I want to put my money somewhere. Now, the whole thing that I will the full amount of money that we engage, the total amount of money that we engage that will cost me, I want to know what it is. I want to know what it is. And how am I going to do it? I'm going to do it by one way, one very simple way. How am I going to do it? I will say, what will my investments or project worth at the beginning, and what will it worth at the end that I divide by 2? It is an average value. I'll take it again. At the beginning of the project, it's as simple as, let me write it here. It's as simple as initial investment plus, this one is cap value divided by 2. Okay. Okay. Divided by 2. Initial investment plus my cap value. So what we are saying here is that I will invest 120,000 in the first year. Then at the end of the last year, it will worth 20,000. As of today, if I want to value my investment, what will I do? I want to get an average number. I will now pick the original value I invested in the first year. I will add what my project will worth, of course, at the end year. I bought the machine for 120,000 the first year. The last year, the machine will value 20,000. I want to say, okay, as of today, safe, on an average, let's say I've invested this money. What will this machine worth? I will now say, okay, 120,000 plus 20,000. divide by 2. I just want to have an average number. Divide by 2. Of course, you know the concept of average now, because I'm summing just 2 numbers. I'm dividing by 2. If I'm summing 3 numbers, I divide by 3, just to get an average value. Then I will now say, aside from this, is there any other cost? That's where I'm saying capital employed. Is there any other cost that we engage? Should go back to the question. The question is saying that there will be additional working capital of 15,000. If I have anything like that, I add it. If I have anything like that, I will add it. So for me to be able to ascertain what my average investment will be, take the value of the investment at the beginning, add it to the value of the investment at the end, divide that by 2. Then if there's any other expenses or any other money you are going to incur, add it to it. So what we are saying is that as of today, on an average, your investment will worth 85,000. The total money that will go out from your pocket is 85,000. The total value of your investment is 85,000. Then your profit is 13,000. Of course, this thing is very simple. Now you now want to do the magic. The magic there is that you want to say, this is my profit, this is my return. Return milele. This is what it costs me. This is what it cost me on this column. This is what I get back in this column. Then the math is very simple. I can now say, okay, my profit divided by what I invested, then whatever percentage is what your annual, your accounting profit is. Oh, no. This one should be the other way around. This one should be average profit. Profit is also come first. This one black. Profit is also come first, divided by investment. Good. This is the formula. So you pick your profits, you divide by what you have invested, then whatever percentage you get is your accounting profit. So it's very simple. It's just looking at it. It's just looking at it at say, let's ascertain our profits, let's ascertain our costs. Then let's do the comparison between the two. Right? What percentage of our cost is in the profit? Now, we have been able to ascertain that is 16%, and they are saying that they will accept the project if the least percent is 15. So meaning that this project is still within the threshold and it can be accepted because it is more than the 15% that was expected. So that is just a glimpse introduction to what ARR is. Guys, I'm very sorry, I need to call it a moment now. But I will take question before I call it a day. Then by Tuesday, we'll continue from there. Don't worry, on Tuesday I'll be fully active.
Good evening, sir.
So go ahead.
Good evening, sir.
Good evening, Mr. Opal Olugbenga. Good evening.
Okay,
Go
sir.
ahead.
The 15,000 of the additional investment, we don't make use of it. So we come across it inside the question. How are we going to use it, sir, to calculate the average investment?
Okay, so we actually use it. This is it now. If you check my formula bar, can you see my formula bar? Is it clear enough? You can see 15,000 here. I have added it. So that 15,000 is part of what you are investing. They say you will need to invest 15,000 as additional working capital. So it's part of what you will invest. It's part of your money that you are going to spend. So it's a cost to you. So you need to add it as part of your cost of investment. So I have added it. So what I've done here is to say 120,000 plus 20,000. 120,000 is the initial cost, 20,000 is the scrap. I divided that by 2, and I added the 15,000, which is the working capital cost. So that is how you treat that 15,000.
Okay, so it means we cannot add everything together before we divide it by 2. We have to add the 120 plus 20,000 before we add the 15,000, the additional investment,
Yes,
sir.
yes. Because the 15,000 is a cost element that is separately different from the cost of the machine. The machine costs 120,000, and as at by the end of the project, or by the end of the year 4, the machine will worth 20,000. So that 15,000 is just like working capital. Boya, you need to invest in day-to-day running of or maintenance. They want to buy oil, they want to do some other things. So they are not actually, the cost is not actually part of what you pay to buy the machine, but still on still, it is part of the money that you have spent to keep that machine in that very good space. So of course, you need to add it to certain what your total investment is, but it's standing separate as it's standing separate from the cost of the machine itself.
Thank you, sir. Thank you,
Right,
sir.
right, Mr. Joshua, you hand this up.
Okay. I want to just ask, in case this kind of question, we saw it in the exam, and if we say cost plus residual value plus working capital divided by the 2, would that be okay with us?
No,
Like
no,
I
no,
said, arrive at average investment.
no, it won't. It won't. Just like I explained now, right? There are two different things. There are two different things. Let's go back to the question. And let me show you in the question. Let me bold it so that. So the question is saying that the investment at the beginning of the project is 120,000. That is what the project worth at the beginning of the project. That's what the machine worth rather. Then at the end of the project, so it will worth 20,000. You understand it to that point. Beginning 120, end 20,000. Right? Now, in the grand scheme of things, if I don't have this 15,000, sometimes I will not have it in the question. So there's no, I don't have any business with it. I will just say 120,000 plus 20,000 divided by 2 so that I can be able to ascertain the average investment.
Investment.
I'll be able to ascertain my average investment. 120,000 plus 20,000 divided by 2. I've ascertained my average investment. That is what I've invested. After today, I'm getting the value. But if the question now goes further to say there is 15,000, the reason why you cannot average that 15,000 is that it is a one-off something. It's not looking at this whether it happened at the beginning or at the year. It's a one-off something, and no matter what, no matter later anytime it happens, it actually sums up to 15,000. So that 15,000 happens once. So you just have to add that 15,000 to the cost of your investment, and it's not part of what you divide by 2. It's just the 120 you invested at the beginning, and the 20,000, which is the value at divided by 2 plus the 15,000. Is that clear?
Okay.
All right, guys, I beg, take an novice. It's a good time for me to pull out now. Then by
And
Tuesday,
thank you very much for that. So will you drop the note for us or after Tuesday class?
I will send this note to you. I will send the notes. Though I think I have what do I have? Okay, I have MPV. And this MPV. I wanted to talk about it today. I have MPV, then I Okay. Let's keep everything to Tuesday. I will drop the note after this class. I would have added. I want to add some other examples to this thing, so that the notes will be comprehensive enough for you guys. So let's keep it to after today's class. I'll drop the notes for you people. All right.
Okay.
Thank you, everyone.
Thank you very much,
Thank you
sir.
so
God
much,
bless
sir.
you.
Thank you, sir.
Thank you, sir.
Thank you,
Thank
See
sir.
you.
Sir.
Mm.
Good
Thank you
night.
so much, sir.
Thank you very much, sir.
All right, boss.
Thank you. God bless you.
Ẹgbẹ́ kalẹ̀ wo ẹ má bínú sí mi jàre ẹ wo. Màá
Thank
jáde
you
ní
so much, sir.
ìṣẹ̀dí lálẹ́ yìí ni. And I need to attend to something na ẹ má bínú ṣe gbọ́ ìjọ. Tomorrow is a good time. We'll take our time to look at it. Ẹ gbọ́ mi. Ẹ ṣe gan. No wahala. That one, see, I don't tell you. That one no be problem. If no be say I dey super enjoy these days. That one no be problem. But yeah. Instead of screaming.